Question 1. Types of annuities. Which of the following best describes the primary advantage of a fixed annuity over a variable annuity? A. Fixed annuities provide investment options that allow for higher returns based on stock market performance. B. Fixed annuities offer a guaranteed minimum return and fixed payments, providing greater predictability and stability. C. Fixed annuities have higher risk and allow for more flexibility in investment choices. D. Fixed annuities do not have surrender charges or penalties associated with early withdrawals. Answer: B. Fixed annuities offer a guaranteed minimum return and fixed payments, providing greater predictability and stability. Explanation: Fixed annuities are designed to provide stable and predictable income streams, offering a guaranteed minimum return regardless of market conditions. This contrasts with variable annuities, which are tied to market performance and carry the risk of investment fluctuations. Fixed annuities are generally favored for their predictability and security, making them a popular choice for retirees seeking stable, reliable income. Option A is incorrect because variable annuities are the ones that offer market-linked investment options. Option C is incorrect because variable annuities involve higher risk due to their exposure to market performance. Option D is also incorrect as fixed annuities may still have surrender charges, which apply if the annuitant withdraws funds before the agreed-upon period. Question 2. Regulatory and legal aspects of annuities. Which of the following is required under Michigan's suitability regulations when recommending an annuity to a client? A. An annuity recommendation must be based on the agent's best interest, not the client's financial situation. B. An annuity recommendation must ensure that the client's financial needs and objectives align with the annuity's features. C. Annuity recommendations are based solely on the potential for high returns without regard to the client's age. D. A financial advisor can recommend an annuity without a suitability analysis if the client expresses a preference for the product. Answer: B. An annuity recommendation must ensure that the client's financial needs and objectives align with the annuity's features. Explanation: Under Michigan's regulations, as well as the NAIC model suitability and annuity transactions, agents are required to conduct a suitability analysis that takes into account the client's financial needs, goals, and objectives before recommending an annuity. This includes evaluating factors such as the client's age, income, financial situation, and risk tolerance to ensure the product is appropriate for them. Option A is incorrect because the recommendation should be based on the client's best interest, not the agent's. Option C is incorrect as it disregards the client's financial goals and is overly focused on returns, which is not a suitable basis for recommending an annuity. Option D is incorrect because even if a client expresses a preference, a suitability analysis is still required. Question 3. Scenario-based question. Annuity sales and suitability. Mr. Robert is a 65-year-old retiree who is considering purchasing a variable annuity. He has a moderate risk tolerance and seeks a product that could provide some growth potential while ensuring a stable income during retirement. Mr. Robert's financial advisor, Susan, has recommended a variable annuity with a mix of stocks, bonds, and international equity sub-accounts. However, Mr. Robert is concerned about the potential market fluctuations and the impact on his income. What should Susan do next? A. Advise Mr. Robert to purchase the variable annuity immediately as it offers the potential for higher returns over time. B. Reevaluate the suitability of the variable annuity based on Mr. Robert's risk tolerance and consider recommending a fixed annuity instead. C. Recommend a fixed annuity with a guaranteed return as Mr. Robert's risk tolerance is too low for the variable annuity. D. Suggest that Mr. Robert invest in a mutual fund rather than an annuity as it will provide more flexibility and fewer fees. Answer: B. Reevaluate the suitability of the variable annuity based on Mr. Robert's risk tolerance and consider recommending a fixed annuity instead. Explanation: In this scenario, Susan should first evaluate whether the variable annuity aligns with Mr. Robert's risk tolerance and retirement goals. While variable annuities offer the potential for higher returns, they also carry greater risk due to their market-based investments, which may not be suitable for someone like Mr. Robert who is nearing retirement and seeking stability. If Susan determines that Mr. Robert's risk tolerance leans more toward conservative investments, she may want to consider a fixed annuity which offers guaranteed returns and fixed payments, providing more stability in retirement. Option A is not appropriate because it disregards Mr. Robert's risk concerns. Option C might be a valid option, but it is not the first step as Susan must first evaluate the current product's suitability. Option D is incorrect because mutual funds do not offer the same income guarantees and protections as annuities, making them unsuitable for this retirement scenario. Question 4. Annuity contracts and provisions. Which of the following provisions is typically included in an annuity contract to protect the policyholder from market downturns during the accumulation phase? A. A market value adjustment MVA rider. B. A guarantee minimum withdrawal Benny Deba ride. C. A free look period provision. D. A surrender charge provision. Answer: B. A guaranteed minimum withdrawal Benny Deba ride. Explanation: the guaranteed minimum withdrawal Ben for Deba rider provides protection to the policyholder by guaranteeing that they can withdraw a certain percentage of their initial premium or a benefit base each year even if the market value of the annuity decreases. This rider helps ensure that the policyholder receives a minimum level of income regardless of market conditions. Option A refers to the market value adjustment MVA, which adjusts the value of the annuity if it is surrendered early but does not provide protection against market downturns. Option C is the free look period, which allows the policyholder to cancel the annuity within a specified time frame after purchase without penalty, but it doesn't protect against market performance. Option D refers to a surrender charge, which applies if the policyholder withdraws funds early, but it doesn't address the protection from market downturns. Question 5. Taxation of annuities. Which of the following tax implications applies to a non-qualified annuity upon withdrawal during the accumulation phase? A. The entire withdrawal is taxed as ordinary income. B. Only the interest earned on the annuity is taxed as ordinary income and the principal is tax-free. C. The withdrawal is tax-free and no taxes are owed on the gains. D. The entire withdrawal is taxed at a lower capital gains tax rate. Answer: B. Only the interest earned on the annuity is taxed as ordinary income and the principal is tax-free. Explanation: in a non-qualified annuity, contributions are made with after-tax dollars, meaning the principal is not taxed upon withdrawal. However, the earnings or interest generated by the annuity are taxed as ordinary income when withdrawn. This is in line with IRS guidelines for non-qualified annuities, where withdrawals are taxed on a last in, first out LIFO basis, meaning that earnings are withdrawn first and taxed. Option A is incorrect because only the earnings are taxed as income, not the entire withdrawal. Option C is incorrect because only the earnings are taxable. Option D is incorrect because annuity withdrawals are taxed at ordinary income tax rates, not capital gains rates. Question 6. Suitability in annuity sales. Which of the following is a key factor that must be considered when determining the suitability of an annuity for a client under Michigan law? A. The client's past annuity purchases. B. The client's preferred investment products and asset allocation. C. The client's financial situation, including age, income, and objectives. D. The client's ability to make a lump sum payment without regard to their long-term financial stability. Answer: C. The client's financial situation, including age, income, and objectives. Explanation: Michigan's suitability regulations require insurance agents to consider a variety of factors when recommending an annuity, including the client's financial situation, age, income, investment objectives, and risk tolerance. This ensures that the product is appropriate for the individual's current and future financial needs. Option A is incorrect because past annuity purchases may not be relevant in assessing the current suitability of a product. Option B is too narrow as it focuses only on investment preferences rather than the full financial picture. Option D is incorrect because long-term financial stability and the client's ability to maintain the annuity are crucial considerations, and this option ignores these aspects. Question 7. Annuity pricing and calculations. If an annuity contract has a 5% annual interest rate and the client is purchasing a fixed annuity for $100,000, how much would the annuity pay out annually in the payout phase if it is structured as a life annuity with a period certain option of 20 years? A. $5,000 annually for life. B. $7,500 annually for life. C. $6,000 annually for the first 20 years. D. $8,000 annually for 20 years, after which it stops. Answer: C. $6,000 annually for the first 20 years. Explanation: in the case of a fixed annuity with a period certain option, the annuity payments are calculated based on the premium and the specified interest rate. The formula to calculate the annual payout is the total premium multiplied by the interest rate divided by the number of periods. Here, assuming a $100,000 premium and a 5% annual interest rate, the payout for 20 years is annual payment equals 100,000 x 0.5 equals 6,000 per year for 20 years. This payout will continue for 20 years, providing Mr. Robert with a predictable income stream for that period. Option A is incorrect because it assumes a payout of 5% of the principal amount, which is not the correct formula for a period certain annuity. Option B is incorrect because it assumes an incorrect payout rate. Option D is incorrect because this would be the case in a fixed period annuity, not a life annuity with a period certain option. Question 8. Ethical considerations and industry standards. Which of the following is an ethical responsibility for an agent selling annuities in Michigan? A. An agent must prioritize their own commission structure over the client's financial needs to ensure a competitive product. B. An agent is required to provide full disclosure of all fees, charges, and surrender penalties associated with the annuity. C. An agent is allowed to recommend a product that may not align with the client's financial goals as long as the product has the highest return potential. D. An agent can recommend an annuity without conducting a suitability analysis if the client is familiar with annuities. Answer. B. An agent is required to provide full disclosure of all fees, charges, and surrender penalties associated with the annuity. Explanation. Ethical annuity sales require agents to fully disclose all terms of the product, including fees, charges, and surrender penalties. Transparency is critical to ensuring that the client understands the full scope of the product's costs and benefits. This disclosure is mandated by both Michigan law and federal regulations like the NAIC Suitability and Annuity Transactions Model Regulation. Option A is unethical because it prioritizes the agent's commission over the client's best interest. Option C is incorrect because it disregards the suitability and ethical obligations to ensure the product is in the client's best interest. Option D is incorrect because a suitability analysis is always required to ensure the product fits the client's financial situation. Question 9. Advanced annuity concepts. Which of the following is a common benefit of inflation protection riders in annuities? A. The rider guarantees that the annuity payments will remain the same throughout the annuitant's lifetime. B. The rider increases the annuity payments over time to account for inflation, maintaining the purchasing power of the annuity. C. The rider allows the annuity holder to withdraw a larger lump sum payment if inflation increases. D. The rider provides a one-time payment increase based on the Consumer Price Index, or PI, when inflation exceeds a certain threshold. Answer. B. The rider increases the annuity payments over time to account for inflation, maintaining the purchasing power of the annuity. Explanation. An inflation protection rider adjusts the annuity payments periodically to account for inflation, ensuring that the income stream maintains its purchasing power over time. This is particularly important for retirees who may face rising living costs during their retirement years. Option A is incorrect because fixed payments do not adjust for inflation. Option C is incorrect because the rider does not allow for lump sum withdrawals. It focuses on payment increases over time. Option D is incorrect because inflation riders are not typically tied to CPI thresholds, but rather to a fixed increase, often based on a percentage or formula. Question 10. Annuities in financial planning. When using an annuity as part of a retirement income strategy, which of the following is a primary advantage of combining an annuity with other investment vehicles? A. Annuities provide flexibility for short-term savings goals, while other investments can offer tax advantages for long-term growth. B. Annuities are best used as the sole source of retirement income, as they offer guaranteed payments for life. C. Combining annuities with other investments can help diversify income sources and mitigate risks, such as longevity risk. D. Annuities and other investments should never be combined, as they offer conflicting financial goals. Answer. C. Combining annuities with other investments can help diversify income sources and mitigate risks, such as longevity risk. Explanation. Combining annuities with other investment vehicles like stocks, bonds, or mutual funds provides a diversified retirement income strategy that can balance stability and growth potential. Annuities address the risk of outliving assets' longevity risk by providing a guaranteed income stream, while other investments offer growth potential that may outperform the fixed payouts of an annuity. Option A is incorrect because annuities are typically not used for short-term savings. They are designed to provide long-term income, particularly in retirement. Additionally, while annuities can have some tax benefits, their primary role is not flexibility for short-term goals. Option B is incorrect because while annuities provide a guaranteed income, relying solely on them can be limiting for a diversified retirement strategy. Other investments, such as equities and bonds, may offer higher returns over time, which can complement the stability of annuities. Option D is incorrect because combining annuities with other investments is a common strategy to enhance diversification and manage different financial risks. Question 11. Annuity options and riders. which of the following annuity riders provides protection against the risk of needing long-term care during the payout phase? A guaranteed minimum withdrawal be a long-term care LTC rider, C, a death benefit rider, D, a step-up rider. Answer B, a long-term care LTC rider. Explanation: the long-term care LTC rider is specifically designed to provide additional protection in case the annuitant requires long-term care services. This rider typically allows the annuity payments to be increased or extended to help cover the costs of long-term care. Option A is incorrect because a guaranteed minimum withdrawal guaranteed the minimum withdrawal amount but does not address long-term care needs. Option C refers to a death benefit rider, which provides a death benefit to beneficiaries but does not provide for long-term care needs. Option D refers to a step-up rider, which allows the annuity's death benefit to increase, often based on market performance, but does not specifically cover long-term care. Question 12. Fixed annuity features. Which of the following best describes the nature of a fixed annuity? A, the annuity payments fluctuate based on market conditions. B, the annuity provides fixed, predictable payments over a specified period or for life. C, the annuity allows for a variable investment option depending on market performance. D, the annuity has a variable interest rate that changes periodically. Answer B, the annuity provides fixed, predictable payments over a specified period or for life. Explanation: a fixed annuity guarantees fixed, predictable payments to the annuitant, either for a specified period or for the rest of their life, based on the premium paid and the terms of the annuity contract. The payments are not subject to market fluctuations, making the annuity a stable and reliable income source. Option A describes a variable annuity where the payments depend on the performance of underlying investments. Option C is incorrect because it describes a variable annuity which offers the possibility of higher returns but with greater risk. Option D also refers to a variable annuity where the interest rate can change based on market conditions. Question 13. Annuity settlement options. Which of the following settlement options allows an annuitant to receive payments for as long as they live, with the option for a beneficiary to continue receiving payments if the annuitant dies early? A, life with period certain. B, joint and survivor life. C, life only. D, fixed period annuity. Answer A, life with period certain. Explanation: the life with period certain settlement option guarantees that the annuitant will receive payments for their entire life, but if the annuitant dies before the period certainty, g. 10 or 20 years, the remaining payments will go to the beneficiary for the remainder of that period. This ensures the annuitant's beneficiary continues to receive the annuity payments if the annuitant passes away early. Option B refers to a joint and survivor life annuity, which provides payments to both the annuitant and a survivor, usually a spouse, for their lifetimes, but not necessarily for a period certain. Option C provides payments only during the annuitant's life with no guaranteed period for beneficiaries. Option D involves payments for a fixed number of years, regardless of the annuitant's life, without lifetime coverage. Question 14. Annuity withdrawals in an annuity contract. Which of the following is typically true about early withdrawals made before the annuitant reaches age 591? A, early withdrawals are not subject to any penalties or taxes. B, early withdrawals are subject to a 10% penalty in addition to ordinary income tax. C, early withdrawals are subject to ordinary income tax, but there is no penalty. D, early withdrawals are allowed without any restrictions. Answer B, early withdrawals are subject to a 10% penalty in addition to ordinary income tax. Explanation: for non-qualified annuities, early withdrawals before age 591 are subject to a 10% early withdrawal penalty imposed by the IRS in addition to the regular income tax on the earnings portion of the withdrawal. This penalty is intended to discourage early access to retirement savings. Option A is incorrect because there is generally a penalty for early withdrawals. Option C is incorrect because while withdrawals are subject to income tax, the 10% penalty also applies. Option D is incorrect because early withdrawals are restricted and penalized unless the annuitant qualifies for specific exceptions such as disability or certain medical expenses. Question 15. Suitability and compliance. Which of the following is required under the NAIC Suitability and Annuity Transactions Model regulation when recommending an annuity product to a client? A, the agent must prioritize the product with the highest commission structure. B. The agent must recommend an annuity based on the client's financial goals, risk tolerance, and suitability for their situation. C. The agent is not required to assess the client's financial status or needs. D. The agent can recommend any annuity as long as it complies with state regulations. Answer: B. The agent must recommend an annuity based on the client's financial goals, risk tolerance, and suitability for their situation. Explanation: under the NAIC Suitability and Annuity Transactions Model Regulation, agents are required to assess the client's financial goals, risk tolerance, and overall suitability before recommending an annuity. This ensures that the recommended annuity is in the best interest of the client based on their unique financial circumstances. Option A is incorrect because commissions should not be the primary driver of product recommendations. Option C is incorrect because assessing the client's financial situation is a key part of the suitability requirement. Option D is incorrect because compliance with state regulations does not override the requirement for suitability analysis. Question 16. Annuity surrender charges. What is the primary purpose of surrender charges in an annuity contract? A. To incentivize the annuitant to hold the annuity for a longer period of time. B. To reduce the annuitant's risk exposure. C. To allow the annuitant to receive a higher interest rate. D. To provide a guaranteed payout amount for the annuitant. Answer: A. To incentivize the annuitant to hold the annuity for a longer period of time. Explanation: surrender charges are imposed on annuitants who withdraw funds from the annuity within a specified period, often the first several years. These charges discourage early withdrawals, which could undermine the long-term financial stability of the annuity. Option B is incorrect because surrender charges do not directly affect the annuitant's risk exposure. Option C is incorrect because surrender charges do not relate to interest rates but to withdrawals. Option D is incorrect because surrender charges are not related to guaranteed payouts, but rather to the penalty for early withdrawal. Question 17. Variable annuities. Which of the following best describes the investment structure of a variable annuity? A. The annuity's value is guaranteed and does not fluctuate with market conditions. B. The annuity's value is tied to the performance of underlying investment options such as stocks, bonds, or mutual funds. C. The annuity provides a fixed interest rate regardless of market performance. D. The annuity guarantees a fixed payout amount based on market rates. Answer: B. The annuity's value is tied to the performance of underlying investment options such as stocks, bonds, or mutual funds. Explanation: a variable annuity allows the annuitant to allocate funds into different investment options such as stock and bond portfolios, whose performance will determine the value of the annuity. Unlike fixed annuities, where payments are guaranteed, variable annuities carry the potential for both higher returns and higher risk. Option A is incorrect because variable annuities are subject to market fluctuations. Option C describes a fixed annuity, not a variable one. Option D is incorrect because variable annuities do not offer guaranteed fixed payouts. Question 18. Annuity withdrawals and taxes. If an annuitant withdraws funds from an annuity before reaching the age of 591, how will the earnings portion of the withdrawal be taxed? A. It will be taxed as long-term capital gains. B. It will be taxed as ordinary income, and a 10% early withdrawal penalty will apply. C. It will not be taxed if the annuitant is under age 591. D. It will be taxed as a tax-free return of principal. Answer: B. It will be taxed as ordinary income, and a 10% early withdrawal penalty will apply. Explanation: withdrawals made before age 591 were subject to ordinary income tax on the earnings portion and a 10% early withdrawal penalty unless specific exceptions apply, e.g. disability, substantial medical expenses. The earnings from the annuity are not treated as long-term capital gains. Option A is incorrect because the earnings are taxed as ordinary income, not capital gains. Option C is incorrect because the earnings are taxed and the penalty applies. Option D is incorrect because the withdrawal is not tax-free. It's subject to tax and penalties. Question 19. Annuity payout phases. What occurs during the accumulation phase of an annuity? A. The annuity starts making regular income payments to the annuitant. B. The annuitant begins to receive payments based on the contract's chosen payout option. C. The annuitant makes contributions and the value of the annuity grows, typically tax deferred. D. The annuitant's annuity payments are locked in for a fixed term. Answer: C. The annuitant makes contributions and the value of the annuity grows, typically tax deferred. Explanation: during the accumulation phase, The annuitant makes contributions to the annuity and the value of the annuity grows tax deferred. The growth can be influenced by the underlying investments in the case of a variable annuity or by a guaranteed fixed interest rate in a fixed annuity. Option A is incorrect because income payments are made during the payout phase. Option B describes the payout phase. Option D is incorrect because payments are not locked in during the accumulation phase. Question 20. Annuity beneficiaries. Which of the following options ensures that an annuitant's beneficiary receives a death benefit if the annuitant dies during the accumulation phase? A joint life rider. B, a guaranteed death benefit rider. C, a life-only annuity. D, a period-setting rider. Answer: B, a guaranteed death benefit rider. Explanation: a guaranteed death benefit rider ensures that if the annuitant dies before the payout phase begins, the beneficiary will receive a death benefit typically at least equal to the premium paid or the value of the annuity at the time of death, whichever is greater. Option A refers to a joint life rider, which covers both the annuitant and a spouse. Option C is incorrect because a life-only annuity provides payments for the annuitant's life only and does not guarantee a death benefit. Option D refers to a period-certain rider which provides payments for a fixed period but is not related to death benefits. Question 21. Fixed-indexed annuities. Which of the following best describes a fixed-indexed annuity? A, it provides fixed interest returns with no connection to market performance. B, it offers returns based on the performance of a stock market index but guarantees a minimum return. C, it invests directly in the stock market for growth potential. D, it provides variable returns and does not guarantee a minimum return. Answer: B, it offers returns based on the performance of a stock market index but guarantees a minimum return. Explanation: a fixed-indexed annuity offers returns that are tied to the performance of a stock market index like the S&P 500 but guarantees a minimum return, which is usually a fixed interest rate. This provides the potential for higher returns while protecting against market losses. Option A is incorrect because fixed-indexed annuities have their returns linked to market performance. Option C describes a variable annuity which invests directly in stocks and bonds. Option D describes the nature of a variable annuity, not a fixed-indexed annuity. Question 22. Annuity tax treatment. Which of the following is true regarding the tax treatment of annuities? A, annuity contributions are tax deductible. B, the entire withdrawal amount, including both principal and earnings, is taxable. C, annuity earnings grow tax-free but are taxed when withdrawn. D, annuity withdrawals are tax-free as long as they are taken after age 591. Answer: C, annuity earnings grow tax-free but are taxed when withdrawn. Explanation: annuities allow for tax-deferred growth, meaning that the earnings from the annuity are not taxed as long as they remain in the contract. However, when the annuitant withdraws funds, the earnings are subject to ordinary income tax. Option A is incorrect because annuity contributions are typically not tax-deductible unless the annuity is within a qualified retirement account. Option B is incorrect because only the earnings portion of a withdrawal is taxable, not the principal. Option D is incorrect because annuity withdrawals are taxed as ordinary income even after age 591. Question 23. Annuity riders. What is the primary benefit of an inflation protection rider on an annuity? A, it increases the annuity payout annually to keep up with inflation. B, it guarantees that the annuity payments will never decrease. C, it allows for an increase in premiums to generate high returns. D, it provides additional funds for emergency medical expenses. Answer A, it increases the annuity payout annually to keep up with inflation. Explanation: an inflation protection rider is designed to adjust the annuity's payout to account for inflation, ensuring that the annuitant's income retains its purchasing power over time. The rider typically increases the payout by a fixed percentage each year or ties it to an inflation index. Option B is incorrect because the rider focuses on increasing payouts, not preventing decreases. Option C describes a feature unrelated to inflation protection. Option D is incorrect because this rider does not specifically address medical expenses. Question 24. Annuity surrender charges. What is typically the purpose of surrender charges in an annuity contract? A, to discourage early withdrawals and ensure the annuity remains intact for long-term income. B, to allow the annuitant to access funds at any time without penalty. C, to increase the value of the annuity based on withdrawals. D, to provide an additional source of income for the annuitant. Answer A. To discourage early withdrawals and ensure the annuity remains intact for long-term income. Explanation. Surrender charges are penalties that apply if the annuitant withdraws money from the annuity during the early years of the contract. These charges are designed to encourage the annuitant to hold the annuity for the long term, allowing the insurance company to manage the investments and provide stable payouts. Option B is incorrect because surrender charges apply to early withdrawals. Option C is incorrect because withdrawals decrease the annuity's value rather than increase it. Option D is incorrect because surrender charges are not a source of income for the annuitant. Question 25. Annuity payout options. Which annuity payout option guarantees payments for the lifetime of the annuitant but does not guarantee payments to a beneficiary upon death? A. Life-only option. B. Joint and survivor option. C. Period certain option. D. Life with period certain option. Answer A. Life-only option. Explanation. The life-only annuity option guarantees payments for the annuitant's lifetime, but once the annuitant dies, the payments cease and there are no payments to beneficiaries. This is the simplest form of an annuity payout. Option B refers to a joint and survivor option, which guarantees payments for the lives of both the annuitant and a designated beneficiary, usually a spouse, meaning payments continue as long as either party is alive. Option C refers to a period certain option, which guarantees payments for a specific period such as 10 or 20 years, regardless of whether the annuitant is alive. Option D refers to a life with period certain option, which guarantees payments for the annuitant's lifetime, but also ensures that if the annuitant dies before the end of the specified period, the beneficiary will continue to receive payments until the period is up. Question 26. Annuities and estate planning. Which of the following is a primary benefit of including an annuity in an estate planning strategy? A. Annuities provide the highest possible returns with minimal risk. B. Annuities can be structured to provide tax-deferred growth and may offer a death benefit to beneficiaries. C. Annuities are exempt from estate taxes. D. Annuities guarantee a higher payout than traditional investment vehicles. Answer B. Annuities can be structured to provide tax-deferred growth and may offer a death benefit to beneficiaries. Explanation. Annuities are commonly used in estate planning because they offer tax-deferred growth, which means the annuity's earnings are not taxed until withdrawn. Additionally, some annuities offer a death benefit, ensuring that the annuitant's beneficiaries receive a lump sum or income payments upon death. Option A is incorrect because annuities, while offering stable returns, do not generally provide the highest possible returns. Option C is incorrect because annuities are subject to estate taxes depending on the structure of the estate. Option D is incorrect because the payout of an annuity is not necessarily higher than traditional investments and can be influenced by several factors such as fees and market performance. Question 27. Annuities versus other retirement products. Which of the following is a key difference between annuities and other retirement products such as IRAs or 401k plans? Annuities provide unlimited tax-deferred growth, while IRAs and 401ks do not. B. Annuities offer a guaranteed income stream for life, whereas IRAs and 401ks do not guarantee any income. C. Annuities are subject to income tax even before withdrawal, while IRAs and 401ks are tax-free. D. Annuities have higher contribution limits than IRAs and 401ks. Answer B. Annuities offer a guaranteed income stream for life, whereas IRAs and 401ks do not guarantee any income. Explanation. One of the key features of annuities is that they can be structured to provide a guaranteed income stream for the lifetime of the annuitant, addressing longevity risk, the risk of outliving one's assets. IRAs and 401ks, while offering tax-deferred growth, do not inherently provide a guaranteed income stream. The value of these accounts depends on investment performance and withdrawals. Option A is incorrect because both IRAs and 401ks allow for tax-deferred growth, but they have annual contribution limits. Option C is incorrect because both annuities and IRAs for 401ks are tax-deferred until withdrawals are made. Option D is incorrect because IRAs and 401ks have higher contribution limits than annuities in most cases. Question 20. Inflation risk and annuities. Which type of annuity would be most suitable for someone concerned about inflation eroding the value of their retirement income? A. Life-only annuity. B. Fixed annuity. C. Fixed indexed annuity. D. Immediate annuity. Answer C. Fixed indexed annuity. Explanation. A fixed indexed annuity is a good choice for someone concerned about inflation because it offers the potential for returns that are linked to the performance of a stock market index, potentially outpacing inflation over time. These annuities typically offer a guaranteed minimum return while also allowing for growth based on market performance. Option A is incorrect because a life-only annuity provides a fixed income that doesn't account for inflation. Option B is incorrect because a fixed annuity provides a set payout which may lose value over time due to inflation. Option D is incorrect because an immediate annuity starts payments immediately and typically the payments are fixed with no adjustment for inflation. Question 29. Annuity payout phase options. Which of the following payout options offers the highest flexibility for the annuitant and their beneficiaries? A. Life-only annuity. B. Joint and survivor annuity. C. Period certain annuity. D. Annuity with a lump sum death benefit. Answer: D. Annuity with a lump sum death benefit. Explanation: an annuity with a lump sum death benefit allows the annuitant to receive regular income payments during their lifetime, but if they pass away, the remaining balance of the annuity, which may include interest or growth, is paid to the beneficiaries in a lump sum. This provides flexibility for both the annuitant and their beneficiaries, allowing for a larger immediate payout upon death. Option A offers no flexibility for beneficiaries after death. Option B ensures ongoing payments to the surviving spouse or beneficiary, but with less flexibility. Option C guarantees payments for a specific period, but the beneficiary only receives payments if the annuitant dies before the end of the period. Question 30. Annuities and tax deferral. Which of the following best explains why annuities are often used in retirement planning? A. Annuities provide tax-free growth and can be used to accumulate wealth for retirement. B. Annuities offer tax-deferred growth, meaning taxes are paid only when funds are withdrawn. C. Annuities are exempt from federal taxes after the age of 591 WO. D. Annuities are the only retirement product that allows for tax-deferred accumulation. Answer: B. Annuities offer tax-deferred growth, meaning taxes are paid only when funds are withdrawn. Explanation: annuities allow for tax-deferred growth, which means that the earnings on the annuity are not taxed as they accumulate. Taxes are due only when funds are withdrawn. This makes annuities an attractive option for retirement planning, as it allows the annuitant's investments to grow without the drag of taxes during the accumulation phase. Option A is incorrect because annuities do not provide tax-free growth. Only the principal and earnings during the accumulation phase are tax-deferred, not tax-free. Option C is incorrect because annuities are subject to tax even after age 591 WO, unless they are part of a tax-advantaged account. Option D is incorrect because other retirement products like IR as in 401(k)(s also offer tax-deferred accumulation.